Let's take a look at what our wise experts have to say as we head into trade this morning. Surendra Goyal of Citi says Indian equities returned 11% over 2016 to 2018. Lackluster FII flow trend was more than offset by robust inflows from domestic mutual funds. While improvement in the FII outlook has supported the recent rally, strong domestic flows have been the key support for valuations. Recent trends add to uncertainties in India. Citi remains cautious on India with a Sensex target of 39,000 for the end of the year.
Okay, money market views. This one comes from B. Prasanna of ICICI Bank. Prasanna says the precarious growth and inflation outlook by dovish ECB, disappointing external trade data from China and uncertainty around Brexit ahead of March end deadline provided a perfect backdrop for dollar to consolidate its gains against majors. Last week, however, dovish monetary policy expectation from systemic central banks are supporting emerging market fund flows. The rupee also remains supported amid foreign flows both in equities and FDI and is likely to remain so in the near future. He expects the rupee to trade in a range of 69.55 to 70.30 for the week. This is a call for the week.
Okay, and on the bonds, B. Prasanna says global growth, inflation and monetary policy stance continues to support the positive outlook for bonds, including emerging markets. EM dedicated funds are seeing positive fund flows both in local and hard currency bonds. Unfortunately, Indian bonds have underperformed amidst persistent fear of high supply. CPI print this week will be an important input to watch out for ahead of the next MPC meeting in April. He expects the old benchmark 10-year gilt to trade between 7.47 to 7.58% and the new 10-year benchmark to trade between 7.3 to 7.42% during this week.
Okay, here's Rima with the world view.
Hi, good morning. There was red on the global screen in Friday's trade. The U.S. markets fell for the fifth day in a row. The indices were down in excess of 2% for the week, marking its worst week in calendar year 2019 so far. And the key reason, as you guys have been pointing out, was the unemployment data. So the February jobs addition was the weakest since September of 2017. U.S. added only 20,000 jobs in February versus expectations of 180,000. And of course, this data is also read in conjunction with the other economic data which came out earlier this week, where China exports fell by more than 20% and ECB had lowered the region's growth forecast to 1.1%. So US ended lower, but the Dow recovered more than 200 points from the day's low to end just about 20-30 points lower, but the Dow futures is down close to about 100 points. Weak on the European market screen as well, so down about 0.5 to 0.7% across the key indices. An added concern there is that there are just about 3 weeks left for UK to leave EU, and there is no deal yet, and the sterling dropped to a 2-week low. Asia is actually a fairly mixed bag right now. So you've seen an intraday recovery in markets like a Nikkei, a Hang Seng. So they'd opened lower, but now currently in the green. The Chinese markets too up close to about 0.1%. Crude prices hovering around at $65.9 per barrel. Initially, there was a negative reaction once the jobs data came out, but then you saw a bit of a recovery there. And now close to $66. SGX Nifty is currently down, but of course we had more than a 1.5% rally last week, and Asia is showing some signs of recovery, but currently down close to about 15 to 20 points. Back to you.
Okay, Rima, thanks a lot for that. Paul Kitney is with us, Chief Equity Strategist at Diver Cap Markets.